Okay, let's dive right into this expert-level valuation gauntlet. We're going to see if Broadcom's soaring stock price is actually justified. Welcome to this explainer. Today we're taking the frameworks of legendary investors to completely stress test Broadcom, ticker symbol AVGO. We've got an absolute mountain of financial data from their Q2 fiscal 2026 earnings report, and we're going to put on our expert investment analyst hats to figure out exactly what this company is really worth.
So here is our valuation gauntlet for today. We'll start with a quick snapshot of Broadcom, then we'll apply our value lenses with Buffett and Graham, shift over to a growth lens with Peter Lynch, build out a raw DCF valuation model, run some market models, and finally, deliver our synthesis and final verdict.
All right, part 1, snapshot, Broadcom at a glance. Broadcom is an absolute AI semiconductor heavyweight right now. They're trading near an all-time high and boasting a massive market cap of $1.56 trillion. In their Q2 FY 2026 report, they posted this incredible 48% annual revenue jump, hitting $22.19 billion. But here is a truly fascinating paradox. Despite that huge top-line growth and actually beating earnings estimates, the stock surprisingly slipped about 3% in after-hours trading. So to understand why that happened, we really need to look under the hood. And honestly, the reason for that little slip comes down entirely to their business model. Broadcom is basically a tale of two segments. Their semiconductor solutions, which include those highly sought-after custom AI chips, drive 68% of their revenue. But their infrastructure software, which now includes the recently acquired VMware, makes up the remaining 32%. Now, that software segment is absolutely critical because it carries a staggering 93% gross margin. That is literally the cash engine they need to fund their incredibly capital-intensive AI hardware roadmap.
Moving on to part 2, value lenses, Buffett and Graham.
If we run Broadcom through Benjamin Graham's classic defensive investor checklist, we get a pretty mixed bag. I mean, it easily passes the adequate size and earning stability tests with that massive market cap and $9.31 billion in GAAP net income. It also easily passes the dividend record test with a confirmed 65-cent quarterly payout. However, its financial condition is a bit stretched for someone as conservative as Graham. They have a healthy $19.6 billion in cash, sure, but they are carrying roughly $66.7 billion in debt. And crucially, it completely fails Graham's test for moderate price-to-earnings and price-to-book multiples. At current levels, it is simply priced way too high for his strict criteria.
To find out exactly what Graham would pay, we can calculate his famous intrinsic value formula, which is the square root of 22.5 times earnings per share times book value per share. For this explainer, we're filling in our derived annualized GAAP EPS of $6.82, and for book value per share, we just take their $87.6 billion in total stockholders' equity divided by roughly 4.87 billion diluted shares, and that gives us $17.98. Okay, let's pause for a second before we run those numbers.
Because when you run that math, you get a Graham fair value of roughly $52.53. Yep, $52. So the crucial takeaway here is that a rigid, deep value investor following Benjamin Graham's strict formulas wouldn't touch Broadcom anywhere near its current market price. For them, the margin of safety just does not exist right now.
Now, Warren Buffett's approach is a bit more nuanced. He loves a wonderful company at a fair price. And Buffett would absolutely love Broadcom's economic moat. They don't just sell generic, off-the-shelf parts, they literally build custom AI accelerators for hyperscalers like Google, Meta, and OpenAI, and they do it on 18 to 24-month design cycles. That creates massive switching costs. Buffett would also really admire the estimated 42% return on equity and the extraordinary owner earnings, which are represented by their $10.26 billion in Q2 free cash flow alone. But the catch for Buffett is always the price. While management is executing brilliantly, he'd probably rate this a hold and wait for a steep market pullback to get that true margin of safety.
Let's switch gears. Part 3, growth lens, Peter Lynch. While Graham demands cheap, tangible assets and a strict margin of safety, Peter Lynch is all about growth at a reasonable price. Lynch famously likes to categorize companies to really understand their trajectory. Is it a slow grower, a stalwart, or a fast grower? Well, Peter Lynch would instantly categorize Broadcom as a fast grower, and this is entirely because of their mind-bending AI chip revenue trajectory. Look at this. In Q2, custom AI chip revenue hit $10.8 billion, growing 143% year over year, and their guidance for Q3 suggests it's going to cross $16 billion. That is over 200% year over year growth. And remember, this isn't just pipeline speculation. This is contracted demand from major hyperscalers who are scaling up their compute power to the gigawatt level. The defining metric here is Peter Lynch's absolute favorite, the PEG ratio, which is price to earnings divided by growth. Now, despite a high forward PE, if we take Broadcom's non-GAAP PE of roughly 37.4 and divide it by their massive 48% total revenue growth rate, we get a PEG ratio of roughly 0.77. In Lynch's framework, any PEG ratio under 1.0 indicates that a stock's growth is actually undervalued relative to its price. So, combined with their strong cash generation offsetting that debt, Peter Lynch would very likely view Broadcom as a clear buy.
All right, part 4. The DCF valuation model.
Enough philosophy for a minute, let's get into the raw math. We're going to build a discounted cash flow, or DCF model, to forecast Broadcom's raw future cash generation and discount it back to today's dollars. To do this, we have to make some educated assumptions. We're taking their phenomenal $10.26 billion in Q2 free cash flow and annualizing it to a starting base of roughly $41 billion. For the next 5 years, we are projecting a conservative 15% blended growth rate. Now, why 15%? Well, because while AI is exploding at over 100%, their software side is much more mature and slower growing, so we have to blend the two. We'll assume a standard 9% weighted average cost of capital, or WACC, and a 3% perpetual terminal growth rate.
Because DCF models are highly sensitive to these kinds of assumptions, we always run a sensitivity matrix. Notice how rapidly the valuation shifts based on your outlook here. If you use a higher 10% discount rate and a lower 2% terminal growth, the value drops to $355. But on the flip side, if you believe in sustained AI growth driving terminal value up to 4% with a cheaper 8% cost of capital, the fair value easily pushes past $600 a share.
Using our baseline assumptions, that's the 9% WACC and 3% terminal growth, the DCF model outputs a fair value of roughly $445 per share. Depending on daily market fluctuations, this indicates the stock is fairly valued right now, or perhaps slightly undervalued, which offers a pretty solid entry point for a long-term investor who really believes in the cash flow story.
Section 5. Market and comparable models.
When we benchmarked Broadcom against competitors outlined by Hudson Labs, it sits very securely as the second largest player in this space behind Nvidia. Now, Nvidia dominates the generalized off-the-shelf GPU market, but Broadcom's unique moat is in custom ASICs, application-specific integrated circuits. They are outperforming peers like AMD, Intel, and Marvell specifically because their hyperscaler clients require these hyper-specialized, incredibly energy-efficient chips that really only Broadcom can design at this massive scale.
However, looking at comparable analysis also forces us to look at their software peers, and this reveals a very specific risk. Remember that after-hour stock slip we talked about earlier? This is why. Broadcom's infrastructure software segment posted $7.18 billion in Q2, missing the analyst consensus of $7.32 billion. It only grew 9% year over year. This is a big deal because those 93% software gross margins are exactly what fund their AI semiconductor war against giants like Nvidia and AMD without bankrupting the balance sheet. So a deceleration here is a real warning sign you have to watch.
And finally, part 6, synthesis and final verdict.
Our analysis reveals a really stark divide in how different investors view modern tech giants. The deep value asset-based model of Benjamin Graham rejects the stock completely with a $52 valuation. Warren Buffett respects the incredible moat and the cash flow, but he'd hold out for a cheaper price. Conversely, Peter Lynch's growth-adjusted PEG ratio screams buy, and our intrinsic DCF base case lands at roughly $445, which absolutely justifies the current premium if you believe those cash flows will materialize.
So, what is our final verdict? Well, it's a cautious buy, specifically for growth investors. The strengths are undeniable. I mean, running a 69% adjusted EBITDA business at a $22 billion quarterly scale is a compounding machine you very rarely see in market history. Plus, they have a confirmed pipeline aiming for $100 billion in AI revenue by 2027. But you absolutely have to monitor the risks. The stock is priced for sheer perfection right now, meaning even a slight miss in VMware software revenue down the road could cause severe valuation compression. So based on the valuation gauntlet we just ran, at what price point does your personal investment philosophy finally trigger a buy for Broadcom? Are you waiting for a Graham-level crash? Are you holding out for a Buffett-style margin of safety? Or are you riding the Lynch growth wave right now? It's a genuinely fascinating question to consider as AI just continues to reshape the entire market. Thanks for joining me on this explainer, and keep crunching those numbers.